Both over the long term and through the COVID pandemic, Build to Rent has proven to offer extremely resilient income and long-term appreciation, a rare and valuable commodity in today's world. This has led to a significant increase in investment into the sector. Our comprehensive Build to Rent database of all schemes across the UK give us a unique insight into this rapidly evolving sector. This database is helping our clients to make informed strategic decisions. There has been a lot of Build to Rent activity across London, with 27,000 units now built and operational, 19,000 under construction, and a further 27,000 with planning. However, this really is only scratching the surface. When you consider that all built stock represents only 3% of our rental market, rising to just 5% once all stock under construction has been delivered, it is easy to see the scale of the opportunity. Based on more established markets globally, our analysis suggests that Build to Rent in London will exceed 30% of total stock once mature. This would mean that we are less than 10% of the way to maturity today. The investment opportunity is vast and is now attracting increased capital from across the globe. To date, the market has been dominated by UK, North American and European investors, and this is continuing. More recently, we have also seen a new wave of capital from Asia and the Middle East, a trend we expect to accelerate. The investment landscape is changing rapidly. During 2021, over 60% of UK investments were bought by overseas capital, and crucially, 22% of transactions were bought by new entrants to the market. We, along with our global capital markets network, are here to help you, our clients, navigate these increasingly complex capital flows. One of the key defining topics for Build to Rent over the next 5 years will be ESG. As you heard earlier, ESG is now prominent in many other asset classes. Whilst it has lagged behind for Build to Rent, it is now rapidly moving up the agenda. From our recent residential investment survey, almost 70% of respondents stated that ESG is now driving their strategic decision making. We are encouraging our clients to prioritise ESG in order to future-proof their assets, minimise obsolescence risk, and drive maximum value in the years to come. And legislation is changing. In 2021, the government put forward proposals for all new lettings of residential properties in London to require a minimum EPC rating of C by 2025. Our research shows that 60% of rental properties currently don't meet this threshold and will therefore be non-compliant. This will be a huge issue and significant cost for many private landlords and will lead to a further reduction of private rented properties, driving a shortfall in supply. And this presents Build to Rent with a huge opportunity to replace our older rental stock with more modern, sustainable housing for the future. As with the office sector, repositioning and conversion of older assets will increase over the year ahead. Dolphin Square, which we sold last year to AXA, is an excellent example. The block, which was built in 1935, comprises 1,233 apartments in Pimlico and will shortly be undergoing a comprehensive refurbishment programme. Central to this will be improving sustainability credentials, including replacing all 6,000 windows, substantial thermal insulation works, and moving away from fossil fuels to become 100% electric. So what does all of this mean for Build to Rent pricing? Demand for rental stock will continue to outstrip supply. In the medium term, the impact of minimum EPC changes and population growth are likely to further exacerbate this. This will support strong rental growth in the medium term. Refurbishment and retrofitting of older obsolete buildings will become increasingly commonplace. This will present investors and developers with a huge opportunity to deliver additional stock. And crucially, increasing volumes of core and core plus capital chasing a limited pool of stock will drive in yields. We expect best-in-class stabilised build-to-rent assets to range from 3.25 to 3.5 for secondary locations in London, and sub 3 for the very best in prime.